Hi, everyone. Welcome to TimingResearch.com Crowd Forecast News, episode number 310 for August 30th, 2021. This is a pre-recorded episode, and this is also the monthly Option Professor solo episode, where he's going to share his thoughts about what he sees going on in the market and what he expects to happen over the next few weeks. My name is David Kosmeter. I'm the creator of Timing Research, and I'm going to go ahead and turn it over to the Option Professor.
Okay, great. Thank you, David. And good to be with all of you today. Just a quick background on myself, Option Professor. We've been doing this for over 25 years. We've educated thousands of people through our live and online seminars throughout the years. And we have a certain amount of product knowledge on the markets that we try to share with you each and every day. Remember, today I'm just sharing with you my opinions and my observations. And of course, I'm giving insights into what I see, my opinions and observations. But this is not advice. Any type of activity you're looking to, you should always go to your brokerage firm, find out what is right for you suitability wise. And of course, do your own due diligence on everything before you make any decisions. Right now, we're going to go over all the different markets and where they are based on some of the charts that I look at, and then basically give some opinions on what we think might be going on. Okay, so we're going to start out here with the S&P 500. That's obviously the broad-based S&P 500 index. Just a quick overview before we get into anything. You know, I'm going to cut to the chase on basically a lot of things that I have done research on. The stock market right now obviously is going on and on and on. It has been because of a couple of things. One is obviously the earnings have been very, very strong. Now, something we brought to people last year in March when we were at the depths of that drop was that businesses were changing. And after the drop in March of last year, the operating leverage, which we brought to everybody's attention, you know, right after the crash, people were going to, companies were going to cut their staff, and people weren't going to be going into work and this and that. And then companies were going to get lean and mean and very, very efficient. Like that's why the cloud is been such a big investment for people. So the cash came in, the operating leverage is tremendous, and therefore you could get an increase of revenues of 5%, but you could get a 15% jump in your earnings because again, operating leverage is the story. And it will remain the story. That's why we're going to be at 5% or better unemployment probably for a very long time. Because again, these companies are not bringing back everybody they used to have. Okay, so that's the big story. Now, the second big story is valuations. Because interest rates have been so low for so long, valuations have expanded dramatically. Now, it's our opinion that that valuation story is coming to an end, which means that we are at peak valuations. So that puts even more pressure on earnings. And again, there's a good shot that the earnings will keep coming in. But again, we are seeing a total different mentality here. Everybody's raising their targets. One gentleman one firm raised it 1,000 S&P points. I mean, that's not an adjustment. That's a total rebuild. And so you've got a situation here where when you look into 2022, if you're a longer term investor, you got to start thinking about how are the comps going to be next year versus this year? Have we used up or pulled forward a lot of the good numbers? And is it going to be easy for this thing, the S&P, to keep going up, 20%, 15% a year? A lot of people think that may not be realistic. Nobody knows. But again, you follow the tape. But again, that's the big story looking forward is will we be getting a little bit of a higher interest rate situation, which will favor the cyclicals and the companies and the value stocks, and maybe will hinder the higher valuation stocks and maybe some of the tech? Or is this a situation where it's going to be like Japan and Germany and Europe, where rates going above 175 which was March's high on the 10-year, is just not going to happen? And everybody who keeps talking about 2 and 2.5% on the 10-year, again, they're just dreaming because there's no evidence of it going there right now. So the point being is that as we look forward, we are going to go into focusing on, at this point in time, the banks, the industrials, the value. Okay. Energy is making a bounce here, but we don't really trust it because all the moving averages, as you'll see, will be pointing down. So again, the banks, the financials, the insurance companies, the industrials, and things like that should be the ones that would benefit as far as we can see right now. Okay, so and then of course the higher dividend stocks, because these people on the sideline, if they do come in en masse, they probably will want a dividend because that's why they're leaving money market, right? And then the second thing is they probably don't want to get into the highest valuations possible at the highest price in the history of mankind. So again, more moderate PEs and a reasonable income that also favors value, cyclicals, industrials, and stuff like that. Okay, so that's the basic view. And now let's get into what's going on with the minutia. One of the biggest concerns we have, obviously, is look, this is a 20-year graph, and those are moving averages, a 12 SMA, 24 SMA, and a 36 SMA. Okay, so you can see we're way up here, 4,500 almost, and look where we are on the 3 moving averages. So there's a lot of real estate between where we are and where these averages are. And if you look back over 20 years, this is inordinate by any stretch of the imagination. Even during 2008 to 2018, 2019, 2020, okay, the market never got this far away from the averages. Okay, even during the crash of 2008, where the great financial crisis happened, you didn't get this far away from the moving averages. So again, there are some people out there who are looking for a black swan event. And the market is set up for a black swan event from the standpoint of how far it is from those averages, right? A black swan event could be something geopolitical. It could be anything, right? But looking at the landscape, you wouldn't see anything wrong. Real estate's going fabulous. The consumer is making tons of money on his stocks. He's making tons of money on his real estate. He hasn't been able to spend much money going out to eat or going on a plane or going on a vacation. So his reserves are quite strong. So it's hard to paint a bad story, right? Now, the other thing is interest rates. Well, you got Powell talking this week, whether they're going to taper or not. What an old story. They're doing $120 billion a month. Okay. What's the worst case scenario coming out of this thing? That they might start tapering. And what is might start tapering? Okay. Most people think these guys are on the slow boat to China. So what are they going to do? Take 10 billion off, 20 billion off? That's still going to be very, very ridiculously accommodative. Okay. So again, that's one of the reasons why interest rates lower for longer still makes a lot of sense. Inflation, of course, was a problem, and it may continue to be above norm. But the biggest thing inflation might have an effect on is those valuations, because historically, when you're at 3% inflation or better, the valuations are at 18-1 on a PE ratio. And that's where our story comes in, that the valuations will be compressing or at least leveling off. Okay. All right. So there you go. This is one of the big problems with the stock market. And this is why we like to look at the lens, because a lot of people are unaware how extended the market is from these moving averages. Has not been a problem. This has been the boy who cried wolf, right? Has not been a problem. But the further up you go, is that becoming less overbought or more overbought? So that's why I don't know if it's going to be after Labor Day. I don't know if it's going to be, anytime soon. But the market at some point may have a pullback. And if there was some kind of a black swan event, it's very vulnerable to a drop because of the fact that it's so extended. And of course, the bullishness out there is extremely high. All right. Now I'm going to pull the lens in. That's the longer term story of the stock market. Let's bring it into a 1-year graph. Okay. So again, just using, we like to use the moving averages because they don't lie. People lie, they're based on time and price. You can't really fool around with time and price, right? So the bottom line is a pretty factual way of trying to follow the trend. You violated it in last year a few times, back in November of last year, but didn't, the moving average itself doesn't turn down. And that's a key. When the moving average itself turns down, I'm talking about the blue line, which is the 36 SMA. When that turns down, then you've got a problem. So the bottom line is let's look, I'll give you an idea. If we go on a 5-year basis, see, this thing was going pretty darn steady here. all the way into 18. And then remember, we had a 25% drop, but the average really just went flat, never really went down. So you got back on the bicycle, and then it kept going all the way up to where? Here. And even when we tanked, look, it only flattened down. So you'd be more nervous if you were a longer term holder if this blue line starts turning down. That's not the case, but it is way up here. Okay. And that's a lot of real estate between here and there. All right, let's go back to the 1 year. So you got an uptrend. And right now the averages come in at 44.58, 44.37, 44.08. They're inverted to the upside and they're all rising. There's really nothing to complain about. Now I'm going to throw on RSI here, which is the relative strength index, because that's a good one to watch. If it's above 50, you're in a bull market. If it's under 50, not so good. If it's above 60, you could accelerate to the upside in a very dramatic fashion. If you're under 40, you could tank in a very dramatic fashion. So let me put it up here and you guys can see that relative strength and add it to the chart, and let's see what it looks like. Okay, RSI right now is at 62. So if this thing starts taking out 4,500, okay, with it at 62, you don't know that it's not going to 70 on RSI, and you don't know you're not going to 4,600. Okay, but you're also at a higher level, because a lot of times, as you can see, it trades between 60 and 50. So right now you've made a new high. This is one thing that you'd want to look at. When we made this high right there, which was at 44.68, the RSI was at, let's see, about 67 and change. And right now we have made a new high up to 4,500. And the RSI has only been going at around 62. So it's not a huge divergence, but it is a divergence. And again, that could be spelling that we could have a little bit of a exhaustion rally going on right now. But again, right now, the markets look very good. There's your moving averages. There's where you want the markets to stay above on the S&P. Let's look at some of the other markets here, like the QQQs, which is your NASDAQ. So we're going to go around all the markets here today. So be patient. Whatever market you're looking at here, you'll get a broad-based look at it. Okay, right here again, where are you? We are on the Qs. Market tried to get underneath the blue line, but the blue line's rising. So once it got above it, that's your buy signal right there. Now here you go. You are looking at where are we here? We're at RSI 66. So again, it's a higher level. It could accelerate to the upside here because it's above 60. So that's a very distinct possibility. But if it starts rolling, and by the way, on the RSI, if it's above 60, I've noticed, and it gets under 58, sometimes a significant correction is coming after that. So if you're an RSI guy, watch your RSI. And then right now you got S&P at 62. If it gets under 58 and it starts breaking one of those averages we talked about, then you could be in a situation where a more significant drop could be happening. Okay, so here you go now on the Qs, 369, 367, 365. Everything's going on the upside. You're up at 374. Okay, so again, with the RSI above 60, you are in a situation where it could have a big spike to the upside, because above 60, that can happen. So keep an eye on that. But if we do pull back, your support is right there. And really that 367, 365, 369, if it got under those three things, and if the 12 gets underneath the 24, then that would be a problem. Right now, it's fine. Right now, it's fine. Okay, let's look at the ones, a couple that I'm looking at here, the catch-up trade. This is the Russell. And this one had some commercial buying. So this one could be the most exciting of the first two, more exciting than the first two, because you see here, it's just crossing the lines, right? And look where your moving averages come in here, 219, 220, 220. So this 220 area is huge, and you're only at 222. So, and yesterday, I think was the first day it really broke through, or the day before. This is small caps, okay? And they involved a lot of energy, a lot of reopenings and epicenters that got hit. So if this thing starts going, now where's your RSI? 54. You see, it's got a lot of room to go. If it goes to 60, then you could maybe get an acceleration and maybe we're going up to 235, okay? So the risk reward here looks pretty attractive to us. Why? Because your moving averages are right there and the darn thing is right there and your RSI has crossed over into the 50 zone. So, this is the one that could be a very, very exciting one. So keep an eye on the Russell. The other one that could be exciting is the transports. Another one that got hit, been a lagger, and everyone's down on the small caps. So, you don't have a big bullish consensus. Now, here's another one, same setup, right? This thing used to be 285, come down. You got a low here, higher low, higher low. That looks good. Is this going to be a 1, 2, 3 where we go 1 up to 260, pull back to 250? And then now it's at 255 and we're going to blow out 260 and get running. RSI, where is it at? 51, just crossing over into 50, So like I say, this one's got a lot of potential if it can get going and the risk reward doesn't look bad because your moving averages come in 255, 253, 254, okay? So this thing starts trading 260 or better, you're going to probably be going pretty good to the upside. And so keep an eye on this. These two here, the Russell and the transports. This is something that is not in the news, and it may very well be in the news in the months ahead if, in fact, we are on our next leg up. So keep an eye on those two. I think that was very important. Okay. And again, a lot of times if you're like to be an individual stock picker, what you can do is you go to these indexes, right? And you look at the top 10 holdings. And then you look at the top 10 holdings and then you got 10 stocks to look at. And then you take those 10 stocks and you do your analysis on them. And maybe you find 1 or 2 out of the 10 that look like they're going to be the leaders. And that's the way you can maybe be a stock picker by using the broad-based indexes. Okay. And the top 10 holdings are readily accessible. All right. Next one. So we went over those stock indexes here. And again, we highlighted the Russell and the transports. With regards to the other markets, well, we just had a couple of markets here today on Thursday announce earnings, and we're going a little bit nuts on the upside. Let's go talk about them right now. Snowflake. They really big guidance, and look at that, $19. And look, again, the thing was, once it got above the blue line, that's your signal, right? That's your signal. Then it got above these red lines. So you should have been in this thing at 280. Right now, you should be in the gravy train. Okay. And you can see it looks very good. And where's your RSI? 67. So it could accelerate. And when above 60, it can accelerate to the upside. That's a good case in point, right? Okay. All right. So there you go on Snowflake. And then the other one was Salesforce, and Salesforce is trying to take on Microsoft, and they must be doing a decent job because they came out with a good report and good guidance. Again, you got above the blue line here. So there's your buy signal. Above the red, another buy signal. You should have been long this thing for a while if you were even watching. And this is all gravy now. And then basically looking at your RSI, look, it's at 67. Anything above 60, you have the risk of what? Accelerating to the upside. So those are two good examples of what I was trying to talk about. Option strategies, when the market is rising like this with higher lows and it gets up here, some people might consider selling puts. So, if you were down here and you were selling 235 puts, or when you moved up here, you sold your 240 puts, moved up here, 245 puts, you'd be collecting money. Put means you are giving, you have the obligation to buy at the strike price. So if you sold one put at 245, you'd have to buy 100 shares at 245 if they put it to you. And they'll put it to you if it goes to 245 or less, potentially. With regards to hedging yourself against an upside move, say you sold the 240 puts when it was at 250 and you took the premium and bought the 260 puts. Well, now you got a free put at 260. Now you got no premium on the 240, so you're going to have to buy it at 240 with no discount. But that 260 put you bought with the 240 money, look what that would have done for you. 15 bucks in the money already. Not bad. Again, optionprofessor.com, we go over this stuff. So, after the broadcast, go over to the website, get your email in with us and start hearing what we're, start seeing what we're seeing and hearing what we're doing or what we're focusing on. Okay. So those are two examples there of what's been hot here today with regards to earnings. Let's go around to different sectors now. Okay. Because these are some of the ones that we think look pretty good. First one we're going to go to is the financials. And the financial interest rates are going back up. Now, I don't know, they're going up to 2%, 2.5%, but they're not at 112 anymore. And they were at 112 a week or two ago, right? On the 10-year note, 1.12%. So now it's at 135 or so. So this stuff likes that. Now, again, the concern would be here. This is the XLF, which is your what? Your sector for all the financials. Is this a double top up here? Right now, we don't really think so. Could pull back because look, you got some real estate here. Not too much of one though, right? And here's your real line in the sand. If this thing were to ever take out 37, that would, to us, be very, very damaging. So risk reward's not too bad. A couple of bucks, $1.88 from where we are to here. And there's your short leash up there at 38.30. And again, where's your RSI? Your RSI is at 64. So again, we're above 60. Could we pop through here and start accelerating to the upside? It's possible, particularly if rates keep going a little bit higher. And rates are, again, fading to the high side right now. The results at a Jackson Hole here probably will have some effect, but if I'm a guessing man, I wouldn't expect anything too dramatic to come out of it. But if the basic vibe is that yields may be rising a bit, 145, 160, something like that, it will be beneficial for the financials in our view. And of course, that's why once it got above here at 36, 37, we've been on it, right? Right. All right, so there's your financials. And again, why would they do better? Because when they get the yield spread moving wider between money market and longer rates, these guys can make more money. And realistically, these houses going up like this, 20% last year alone, I mean, you don't think these consumers are going to start refining and spending that money? I mean, come on. So there's a big game, I think, of refi coming down the road because, after they go, through a lot of the cash that they've built up, then they're going to need more money down the road. And how they're going to get more money, they're going to look around at their house and they're going to say, hey, listen, rates are still pretty low. Let's get some of that cash and we can spend that. So I think there's a big refi boom coming in the real estate market. Consumers like to spend money and they don't like to have money sitting around, especially like things in their house. Okay, so there you go. And let's go to the next one we thought was very good, which is in industrials. Oh, let's get this up here. Okay, so on industrials, how are they looking? They're looking good. And again, the risk reward doesn't look so bad here because here's your moving averages and that's what the price is. So again, if we had a talk in October, November, December, is it possible we're at 108 or better? That's the direction, right? And of course, there's your lines in the sand at 104, 103, 103 and change. And you're only at 104 and change. So doesn't look too bad. And RSI is at 54. So it's in the plus zone. It's above 50. And so right now, the odds look like it could keep going. And again, the rope you have to give it is pretty small. And I like that. So there's your industrials. Okay. Let's look at energy. This is the problem with energy. The problem with energy is that the trend looks lousy, right? But it is lower. Look, it's 56 and all the way down to 44. But, who likes to buy into a moving average pointing straight down? Now, again, if it's pointing straight down like it was over here and it can break above the average, like it did here, well, that's a horse of another color, right? So what am I saying? if this thing can break above the moving average here, which is at 49 and change, I don't think it was a coincidence that it went up to 48.65 and it's back. Well, where did it go yesterday? 49.04 and backed off a bit. So again, is that gap going to get filled down there? If not, and it breaks above 49.20, which is again where the moving average comes in here, 49.20, that's the 36 SMA. And look, the RSI is at 48. So you're on the verge of it being good. You're on the verge of it being good. If we get the 48 going into the 50s, if we get this thing getting above 49.20, then of course I might be more of a believer, and maybe it'll look more like it did here when it was looking lousy and it broke above 30. A guy over Goldman Sachs, Jeff Curry or something like that, he's very bullish on oil. He thinks in the fourth quarter we could hit $80 a barrel. Well, if he's right, then we will probably break through this, and you'll be on your way. But I don't want to. You don't have to be the first guy at the party. And so anyway, keep an eye on that. Now I'll give you two other ones on the energy front. And there you go. It's the same kind of chart. This is your XOPs, your exploration and production producers. So basically it's the same story, and then you got what, 82.31. And yesterday's high was lower than that. So again, very similar. Look at the chart down here. Looked lousy, lousy, lousy. Lousy, lousy, lousy. And then once it got above the blue line and the red line, everything was a go. So this thing has gotten above the red and the green. So you got to give it some credit, right? But the red and the green are still inverted to the downside. That's not great. And so basically, getting above 82.31 would be important. And again, same with the RSI. You see RSI is at 48. I'd like to get it in the 50s. If you notice, when RSI got under 50, which is right here, it's at 55. Once you got into the under 50, you went from 95, and you've been on a downtrend ever since. It tried to go up here toward it, couldn't do it. Now, again, it's right there. So if it turns down from here, all bets are off. Let's take a look at that. If it gets under 60, if it's above 60 and it gets under 58, does it start accelerating to the downside a bit? Let's find out. Right here, RSI is at 64 and the market's at about 95. Then the market comes down here and it's at about 55. And now the market is about 93. So now it's under, it was above 60 and it's under 58. Now look what happens. Bam, all the way down, big correction. So on the S&P as well, you're at 62. If that S&P RSI gets underneath 58, might be a signal that we're going to have a pullback. Okay, so keep an eye on that. That's a good example of what I was trying to tell you. Okay, and the other one that people look at, which is really the Ferrari as far as volatility, is OIH, which is your oil servicing. And this thing is very volatile. And you can see right there, very big moves. Okay. I mean, when it turned last time, it went from 100 and it went all the way up to 230. That's a pretty good move, right? And even the initial bounce was 100 to 160. That's a 60% jump. Come on. So this baby is really volatile. If you want to play the most volatile one, this is the one. Now, again, same setup. Same setup. Where do you got to get above? You got to get above 188, 63. And currently we're at 184. So are we close? We're close. And again, it's the same setup as the other two, only this thing runs fast, much faster as far as numbers are concerned. I mean, here, 160 to 183, that's a 23-point move. The other stuff moves $1 here, $3 there, $2 there, something like that. This thing goes big when it goes big. And I'll pull it back for you to see what kind of potential it has if it really gets going, because this is scary. You see the kind of potential it has if it ever got going? I mean, this thing could go to 600 very easily. If we're going to $80 crude, like this guy Curry over at Goldman Sachs is predicting in the fourth quarter, this thing could really, really go big. So keep an eye on the oil services. I would say just be a little careful right now, because again, that blue line is not lying. It is the trend as far as we consider it. And the trend looks very much down, and this looks like a dead cat bounce, but we will see. And we will see very shortly, because you can see 48 on the RSI, very close to 50. And the blue line, the 36 SMA, is coming right into play. We've already gotten above the 24 and the 12 SMA. So those are good things, but they're still inverted to the downside. Now, here's the thing. When these things join together, you generally get a very big move as well. So you see the two lines here on the 20-year. You are at 169 and 169. That's almost the same, right? So you generally get a pretty good sized move when they come together. You see they come together here and here. And we got a big move to the downside. They came together right here, and then they started to make their turn. We had a good sized move on the upside. So when they come together, here's on this chart over here, look, they came together over here, all of them. That's when you sometimes get a big move. So I would say that a very big move is in the offing. But again, your RSI is not above 50. And you'd certainly like it to be above 50 if you're thinking about 400 or 600. But energy is going to be very interesting. And then, like I say, if this guy at Goldman Sachs with his $80 prediction is correct, this stuff more than likely will be flying to the upside. Okay, let's see some other areas here now. Value. I'm using the Vanguard as an example of the value. And we are going to go back to the 1-year chart so we get a smaller perspective. And you can see here, get above the blue line, boom, you're in there, right? So you should be in there at about 100, 101. It's only at 102.80. So your risk reward isn't too bad. Is that going to stop it? I don't know. Right now it's coming off a little bit. So maybe it's going to stop here and come back in. But as long as you're above 100, I think this thing's in good shape. You get under 100, then somebody changed the music. And when they change the music, you got to do something about it. Okay. And then there is a high dividend paying one. And this is high dividend. And I'm thinking this is where the people are going to gravitate with the sideline money, because they got reasonable valuations and a good cash flow. Again, why would they be leaving money market, or why would they be leaving fixed income? Because they can't make it on the no interest or low interest. So the first priority they probably have is to get some income. So that's why the high yield stuff, the high dividend yield stuff might be interesting. Here on a one-stop shop, they get a diversified portfolio of it, right? And and you can see it was doing great, right? Okay, because that's when interest rates were rising. Remember, we went in March up to 175, and we started out at 150 at 55 on the 10-year. Well, that higher interest rates, this thing loves it. But then interest rates backed off, and we went all the way down to like 125. So you drop at that point. And then we had a pullback again when we saw interest rates dropping. So if interest rates drop, would not be positive for this necessarily. So there you go. It looks like there could be potential there going into the end of the year. And your RSI is not bad at the 57 mark. Again, if we get above 60, we could accelerate to 110 or better. Okay. Here's one that I've been looking at here. And this is a one-stop shop where you get the world in one bite. Again, this is total world. And this goes like 60% US companies, right? And then the other 40% is split between Asia, emerging markets, and Europe. So if you really think that the rest of the world, it's going to be a worldwide recovery. Well, emerging markets and Asia, are still in the process, and so is Europe, of opening, because they've got a lot of the COVID stuff still problematic, right? And their vaccinations in Asia stink. So if there is a big future for the international picture, here's a one-stop shop that would get you involved in a 60-40 split between the international and domestic. And I find that kind of interesting. So here you go. And, the setup is not bad because you've got all the moving averages in the 104s, right? 104, 105, and the darn thing is trading 105. So, you're not too far from from land here, right? You're not way out to sea, and so, basically looking at that is not bad either. If this thing starts taking out 103, then you've got something changing in the music and you've got to act accordingly. Okay. So there's a little one-stop shop if you want to take on the world, right? Okay. Couple other things here. European banks, their valuation, like they have a price to book on US banks. Well, our price to books in our banks are much higher. Citigroup is one of the ones that are discounted a bit, but the other ones like JP Morgan, I think it's 2 or better a price to book. The price to book on these European banks are a fraction of the price of book. So it'd be like, 0.40 to book. So the bottom line is that these things valuation wise are still pretty darn cheap and they may have a bright future. So here you go. You are in a positive mode on the moving averages. You basically want this thing staying above 1977. The darn thing's only trading 2024. And the RSI is at, let's see, 55. So again, if it gets above 60, you could accelerate. In fact, if it's going to take out this number here and that number there, you're going to go into the 60s. Okay, so we'll have to see about this. But, one way to play European financials is through this vehicle right here. Since we're on the international picture, I'm going to throw a few ones up. INDA, people are in love with India. They think the demographics are fantastic. Let's see. Okay, yeah, your demographics look pretty good on the chart too. So again, let's what it looks like on a 20-year basis. Okay, so it looks all time. Well, this hadn't been around that long, but obviously this thing has been working pretty good. A little bit extended here, right? But again, once you get above 60 is when you can get an acceleration, and the RSI right now is above 60. So again, as a longer term hold, India, that's one of the ways to play it. The other guy who's making out is Mexico. They had a tremendous growth number this week. And they are supposed to be a beneficiary. So again, this thing here, you'd want it to stay above the moving averages, which are coming in at, where are they coming in? The 52 on the RSI is not bad, and 49, 49, 48, and you're trading 49. So not too far from land. And again, with the 52, if it gets above 60, you're probably blowing out 50 and going into a higher area. It's not been a bad place to be, though, in the last year, right? Started out at 31, already at 50. And they're supposed to benefit quite a bit. Their trade balance with us, as you would imagine, are probably very good. Here's a stock that got hit. And if you think that the consumer discretionaries are going to be good, this might be something to look at. They got a nice addictive product, right? Starbucks. Let's take a look. Okay, you see right here, the averages are coming together. So this thing is either going to take out 113 and be real problematic, or if it can get above here, which is 115.72, the high today was 115.99, or yesterday's high. So again, you blow out 16 bucks, I think 116, I think you're in good shape. And if you blow out 118 and a half, you'll blow this out. So this one here, if you can get to blow above 116, that would be your first signal. And then your next signal really comes in at 118 and change. And then that would open the door to fill this gap up here, or maybe even take out the high. RSI right now is in the 40s. So that's why it's not really a great momentum deal here, and why you might want to be patient. Let's see if it can take out yesterday's high. Today, it didn't take out yesterday's high. So basically, yeah, That's 116 is the line in the sand right now, and then 118 and change. But if you think the consumer's coming back, if you want to look at consumer discretionary, and you want to look at something that could play a mean game of catch up, this might be the one. And it's it's a major holding of a lot of big 13F filers. Okay, another international deal, small caps. This one is just turning as well. This is small cap international ex-US, which means no US. So really, if you wanted to do small cap domestic, you go IWM. If you want to go small cap international, here's one for that. And then you got small caps covered for the whole planet, right? All right, so there you go. And you see it's above its lines and they're all coming together. So it could be an exciting time here. You want it to stay above 137. The darn thing is at 137 and change. So you're not that far from dry land, right? And the RSI is at 53. So if this RSI is going to go to 60 and break out, you're probably going to blow out 40 and get up there. And likewise, if you start seeing it take out 137 and go after this gap, and after it fills that gap, if it blows out here, then all bets are off. But right now, it's pretty close to where it is. So again, recent highs have been about 138 and change. So if it takes out the recent highs of 138, I guess, 138.20, then you might have something going here. So keep an eye on this one. This is all world small caps. Okay, let's look at some of the FANGs real quick because a lot of people are in those. Apple, too many A's. I just saw Mr. Cook's getting like $750 million today, so I hope he's buying lunch. That's a reward for his work. And oh boy, hold on. One moment here, I'll fix this up. All right. Let's give it a moment here. All right. Yeah, Apple's been doing great again, and it's a pretty interesting stock because I'll show you how we were talking about it. Because it's very interesting. Let's go back on the 5 year so I can show you. And this is how we did Nvidia. So here you go. When they announced their split, which was last year, going into the end of the summer. Okay, this is about where they announced it, and you can see the stock went from here all the way up here, right? Then it had a pullback of about 60%, which is like a Fibonacci number. And then it went from there and it took off. So as soon as they announced the split, we thought it would rally, and it did. And then right after the split, it tanked 60% pullback. And that's where we thought it was time to get in. We're also using the blue line. And then it went up and where it is now. So right now, where are you at? You're at the 150 area seems to be somewhat resistant around 151. It's having some trouble getting through there. Your RSI is up at almost 70. So I don't know, is the move from 130 to 150 the spike? And now we're going to pull back. RSI looks like a little bit of a divergence between the new high and where it was. So we'll have to see. But clearly 151 is some resistance, but clearly the market is definitely in a bullish mode. So again, when these things come together, that's sometimes when you get a pop, right? So let's see if it takes out 151. But your lines in the sand, which is what you need whenever you're in any investment, is 142, 134, and 133. So when you're up at 151, you're almost $20 above the 24 and the 36, which is a little bit extended. So again, a pullback would not shock anybody, but the trend looks like it's up and the RSI is elevated. So a pullback on the RSI towards 60 might not be off the chart either, but clearly it's uptrending. Now I'm going to show you Nvidia. So why what happened here works so well over here. And we only need a 1 year chart on Nvidia. See if I can get this going here. All right, and this is the 1 year chart on Apple. So you can see everything's coming close here. So if Apple starts getting under 146, 147, actually 147, then I would be careful that Apple could be having a bit of a pullback, because on the 1 year, you're at 55. So again, if you can get above 60, that means what? You probably are above 150 and you're going to 155, 160, right? If we can get the RSI above what? 60 and get this thing to take out this 151 area. Okay. Likewise, on the downside, this thing gets underneath 147, you'd have to be a little bit careful that we could have a pullback because something's changed. Somebody's changing the music, right? And it had a big run, 120 all the way up to here. All right, now let's talk about Nvidia. Okay, on Nvidia, this is how the call worked. They announced that they were going to be splitting. I think July was the date, right? That they were going to do the split. And right now, to give you an idea, Nvidia is really going for $876. Okay. So again, before the split, which was back here, right? In May, they announced the split. So there you go. Boom, 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 boom. We're bullish all the way up. We're bullish all the way up. They do the split and we say there'll be a pullback. Market has a pullback, boom, right back and through the blue line. And then once that pullback happened, that's when we got back on board. And this is basically when we got bullish again as it got above 185. Again, where's the RSI? It's got to be huge up here. What is it? 65? Okay, well, that's pretty good. But again, here the RSI is at 50. So see, once it's above here, right, the RSI is trading 50, 56, 56, 56, right? And boom, then it got under here. And then watch, once it gets above 60, which is right here, this is where you can accelerate to the upside, right? So again, but that's quite a divergence. So I'd be a little bit nervous up here, to be honest. I mean, here, you're looking at the RSI way here, market is way up there. So this number 225 might be a point to defend. So again, if you own this, what strategy might one consider? One might consider, if they thought 225 was the end of the story, you know what the calls are going for up here? I mean, they're probably huge. Let's take a look. Got to hit option prices. Okay. Yeah, Nvidia is at where it is now. Now these are going off the board right away here. So this is going off the board in 5 days. Let's say you went out a month. Let's go out to the 24th of September. Yeah, take a look at these things. 225, you're getting $7. That means you'd be willing to sell Nvidia for 225 plus 7 or 232. If you want to go a little bit closer to the money, stock is trading, we said, I think around 215 or something like that. You're getting $12, which is really like selling the stock at 227. But let's say you went with an out of the money. You could take something like this, which is your 225, and you get $7. So say you thought the high was in. All right, let's go give it another nickel. Go up and get either 225 or 230. And if you sold that, that means you're willing to sell the stock, and you would be obligated to deliver stock and sell it at 225 or 230. You get $5 or $7, right? Now let's look at the puts. Okay, the puts at, it looks like the puts at 215. The puts at 215 are about $5. So you could take the premium off the 230 or the 225 and buy a put here, which means if the market drops, you have got the right, but not the obligation to sell at 215. Let's go back over to the stock and take a look at what that means. And this will give you an idea what a collar looks like. That's where you sell it out of the money call, take the premium, and then you buy a put with the premium. It's an ability for you to have something that would benefit from a decline. And so right now you see the stocks in the 219 area. So if you sold the 225 or 230 calls, use the premium to buy a put down here at 215 or 220. If this market is going to come down and correct, maybe come down to 207, you'd have an ability to be hedged up here at the higher level. But again, the opportunity risk is you are capping your upside at 225 or 230. And then the real risk is the difference between the current price and where the strike price you choose on the put. Again, at optionprofessor.com, if you have any questions, you can always shoot us at optionprofessor@gmail.com, and we'll try to get to all the questions we can and give you some details on different things. Okay, right now I'm going to go over a couple of different in the commodity sector. So let's go over here. And give you some idea here. Again, this is one here on the soybeans, just to give you an idea on the agricultural sector. I'm going to see real quick if I can do something here by going backwards. Just give me a moment. I'm going to try to go back here so I can go on to my old charts. Okay, good. But I want to get my moving averages back up there so you guys can see them. The moving averages are quite helpful. And they were taken away from me when I went to the other chart. So here, let's look at your November soybeans because I think they're pretty interesting. Got a few minutes left, so I just want to cover these real quick. Again, soybeans had a big move. Last year, we got very positive in the $8 to $10 range. They went all the way up to like 15 or 17. So it was a fantastic call being bullish on beans last year, which what we were. Then they ran up here to 15. Now you can see here that maybe it's hard to say because it's choppy. This is choppy. Choppy is either a prelude to going right back up again, or it can be a prelude to what? A breakdown. That's what choppy can lead to, right? Okay, so right now, what's the evidence say price-wise? The evidence price-wise is this. The market's at 1324 on this. Where are you at on the 12? 1335, 1339, and 1348. You're all inverted to the downside. So realistically, although this is choppy, which means the moving average can be very much not helpful. If you had a gun to your head, you would have, and you look at these graphs, you'd have to be thinking that there's a drop coming. The RSI is under 50. That's not good. The moving averages are all inverted to the downside, and the market's trading underneath. So this one could be one that could go down very significantly. But because it's been choppy, there's the risk. But again, would it surprise me if it went down to 12? No. And again, would it surprise me if it went up to 14? Because it's choppy? No. So that's what makes it kind of risky because, again, it has not been trending. And the moving averages work with a trending market, but they get you get chopped alive in a choppy market. Okay. But if this thing is going to start trending, then either A, it's a fantastic buy above 1350 and 1375, or it's going to be a fantastic sell. So this is one I'd watch and see if it's going to start trending. And if it is, then you could have something that could be significantly moving up or down. Okay, let's turn to the metals. This is another one similar to the soybeans. It's either going to be making a big move to the downside or upside because it's been choppy. Right now, today, I think it's, well, no, now it's back up on the day. That's why this thing is, but I'll show you exactly how we have been talking about for traders. Okay, you see choppy, choppy, choppy here, choppy, choppy, choppy. But again, once it gets underneath all the averages, the risk is that it pops way down. So again, if this thing starts breaking under 1360 or 1760 or 1770, then you're going to be setting up for another big drop. Conversely, if this one right here gets taken out, I think it's going to be going, because like I say, where's your RSI now? 49. You're on the ledge, and no one's talking really about gold. It's all about Bitcoin. Now, here's the thing that gets me on the gold. This is a 20-year graph. And again, the monetary base has gone up 9 times in the last 10 years and 2 times in 1 year. So that's a lot of printing. Okay, here's the deal. This is on the 20-year. It looks like a 20-year. No. I'm looking for the 20-year. There you go. Okay, you can see it's still in a bull market. We got very bullish on this down here at 1300. Then it pulled back, got bullish here. Then it pulled back, got bullish here. Now, again, we might be very much getting bullish again, because look where the moving average is. 1813, 1733, and 1593. They're inverted to the upside. So we have been saying that if we can get above and maintain above, see, we got above here, but we didn't maintain. And the 1 year, the 12 SMA is rolling over. So again, getting above 1815 and then 1865 would get this thing going. So again, we're not going to get in there on a short-term basis right now, because we are looking for more price confirmation. And if this thing gives it up, it could go all the way down to 1600 for all you know. But again, very exciting for gold. And sometimes the end of the calendar year and the beginning of the new year is where gold makes its biggest moves. So again, you do have an uptrending thing here, right? That's good. You've got a situation where the fundamentals of printing money and inflation are certainly there, and low interest. So again, when gold had its biggest run in the 80s, 40 years ago, it was because interest rates were at 4% and inflation went to 10. Well, right now we've got inflation at 3 or 4, 5%, whatever. And interest rates are at 1.25. So the setup is there for the thing to fly. But we like to follow the price, not just opinions. So again, if we can get above 1815 and hold, and then if for whatever reason get above 1865 and 1900, it opens the door for all those high prices people have been talking about. So keep an eye on that, because that'll be interesting. And I'll just close out with the silver. Oh, let me close out with the crypto too. Hold on. Silver is the same story on gold, in that it's on the verge. I think it needs to get above about 26 or something to really be going. But here's your Bitcoin. Let's go back 5 years. Okay, again, from here, this is where we came up with this. From here to here, a 61% pullback was right here. That's where we told everybody the lows are in July. Has that been an accurate forecast? I would say so. So that's where we came up with the number. You measure from there to there, you take 61% off, you're there, that's where you get in. Now it's up here. Again, when you buy on strength with Bitcoin, it's not as good as when you buy the drops. And Ethereum. Same story, but I just want to show you. July was the low until taken out. When a market makes a price, like the 10-year note made a price in March of 175. 175 is it until they prove otherwise. So these people looking for really, really high interest rates, we've established a high at 175 on the 10-year note. When it gets taken out, then I'll start listening to what? Higher interest rates. This stuff here made a low in July, okay? Just like Bitcoin did, right? And that's the low. And we're going to operate accordingly until that gets taken out, because that has an established price, right? Just like when it makes a high here, that's the high until what? It gets taken out, until you have evidence of it. Okay. So anyway, that's the ideas we went over here today. Again, optionprofessor.com. We do come out with a weekly update, and we have other information through PDF files that we provide on different option strategies. We've been doing this for over 25 years. We have product knowledge. We go over the use and the risk of the strategies. These strategies are not right for everybody. We always tell people to consult your brokerage firm because that's where you have the financial relationship. Though you and them are supposed to be figuring out what's suitable, what's right, what's your risk tolerance level, and all that kind of stuff, right? So again, we have information and we have opinion and we share them with you. And we take all of our knowledge and all of our experience, which is very, very extensive, and we share it. So just go to optionprofessor.com. If you have questions or comments, optionprofessor@gmail.com. Get on the email list so you can hear what we're saying and get our viewpoints and put it into your research mix. And again, if questions come up, you can shoot us an email and we try to get to everybody. And if we have the answer or an opinion, we'll give it to you. And if we don't, we'll tell you that as well. Okay. This is the optionprofessor.com. And we do appreciate you being here. We do hope that all your trading is positive. And right now, I'm going to turn it back over to David Kosmeter, who will then tell you a little bit about timing research. And have a great weekend, everybody. And again, this will be coming out on Monday. So we'll see what Powell has done and see if the volatility is picked up. But I gave you quite a number of markets to keep an eye on. So let's see how we look after Labor Day. Again, thanks a lot for being here. This is optionprofessor.com. Go over to the website, sign up, and we'll see you then.
All right. Thanks to the Option Professor for his market update. And just a quick reminder for everyone, be sure to subscribe to Timing Research on YouTube and your favorite podcast app. And you can also just go to TimingResearch.com to get access to the archive of this episode, as well as any of the past shows or reports. And again, just want to thank the Option Professor of optionprofessor.com for today's update. Thanks, everyone.